So we'll now try to study more about the option premium and how we derive the value of the premiums. So some terminology that we must be aware of. Intrinsic value of an option is the value that you will receive if you exercise the option today. In the case of a call option, the intrinsic value will be higher of S minus K or 0. So if S is greater than K, then you receive S minus K. Otherwise, you will simply not exercise. So this will be the intrinsic value for a call option. Intrinsic value for a put option would be K minus S, comma 0. So this is the value that you receive if you exercise the option today. The option has two values. It has an intrinsic value as well as a time value. So even if an option is out of the money today, that is, let's assume the spot price is 90 and the strike price is $100 for a call option. And the option right now is out of the money because it's still $10 until which we will exercise it. At 90 we won't exercise the option. Why will we buy at 100? We'll rather buy from the market at 90. So if somebody sells a call option which gives me the right to buy at $100 when the current spot price is 90, will that call option still have some value? Let's assume it's a 1-year option, or 1 year is the time to maturity. So will this call option still have some price or not? The spot price is 90, the strike price is 100. The premium that I'm paying for this option will be a positive number because there is some possibility that this price can go above 100 in 1 year and the option can come in the money and there will be a payoff, because to the buyer there is only upside. If it doesn't, it's okay, he will not exercise the option, but there is some chance that it may go up, and to that extent some premium has to be charged. So for out of the money options, the premium charged is only equal to the time value. Time value represents the probability that the option may come in the money in the future. So in the future, the stock price may go up and the option may come in the money. Intrinsic value is how much would we get by exercising it today. The total value of the option is the intrinsic value plus the time value. So time value is it may come in the money in the future or it may come more in the money. If it is already in the money, it may go more in the money in the future. So if the spot price is 110 and the strike price is 100, then the intrinsic value of this option itself is $10. That is, by exercising it today, I can receive $10. The total premium will be something higher than this to account for the probability that it may go more in the money in the future. In the money is if the spot price is greater than the strike price for a call option, and if the strike price is lower than the spot price for the put option. At the money, if spot price is equal to the strike price. Out of the money, the other way around, if spot is less than the strike for a call and a spot is greater than the strike for a put option. As the spot price goes up, the call option starts to come in the money. Until the strike, the intrinsic value is 0 or the option will not be exercised. After the spot goes above the strike, there will be a 45-degree line according to which the payoff will move. That is, as the spot goes up, the profit goes up by equal amount. If spot goes up by $10, profit will go up by $10. The total premium that we will pay for the option, we will derive in the next session an option valuation. But please note, that will be a sum of the intrinsic value as well as the time value. Intrinsic value is how much in the money we are currently, and time value accounts for the fact that the option may come in the money in the future, or it may come more in the money in the future. So total value will be the intrinsic value plus the time value. For deep out of the money options, the premium will be very low. For deep in the money options, premium will be very high because you're already so much in the money. Remember, and we will prove it when we do the Black-Scholes model, the time value of an option is maximum when it is at the money. Or the time value of the options is maximum for at the money options. Please note that until the spot price is below the strike price for a call option, the value of the option is only the time value. There is no intrinsic value. So whatever is the value is all time value. As the spot moves up, the time value keeps increasing. When it is close to maturity, the value of the option will be quite high because it can come in the money anytime now. So the value will be quite high, but all of it still will just be the time value. So time value is highest for at the money options. We will prove it as well when we study the Black-Scholes model. For now, just remember this. Similarly, for put options, as the spot goes below the strike, the option starts coming in the money. The premium will be the sum of the intrinsic value as well as the time value. We next try to understand the limiting values of options. So the maximum price of a call option will be the current spot price. So the call option is basically a right to buy. If the premium being charged is more than the current spot price, will I ever pay that premium? I will rather just buy the stock itself. The stock costs $100. Even if I think that the stock is going to become 10 times, that's why I'm buying a call option. The premium charged has to be lower than $100. If somebody is charging me a premium of $110, will I ever buy the call option? I will rather just buy the stock myself and save on $10 because this is also eventually a right to buy the stock. So the price of a European call option can never be more than the spot price. Price of an American call option, or rather price of any call option, can never be more than the current spot price because I will otherwise just rather buy the stock. Price of an American call option, that is capital C, will always be greater than or equal to the price of a European call option because there is an added feature that you can exercise whenever you like. Otherwise, they're both the same. Now, the question is, what is the minimum value of a European call option? So that can be derived from the put call parity. So we said C minus P is equal to S minus K e raised to power minus RT, or we can say that C is equal to P plus S minus K e raised to power minus RT. If P has to be positive, that is, the price of any option will always be positive. Even if it is deep out of the money, it can be a very small positive number, but there will be some price of an option. You will never pay somebody for giving him the right also. You give somebody the right to buy or the right to sell, you will charge something. It can be a very small amount if the option is deep out of the money. So P is always positive. So premiums are always greater than 0. That means C must always be greater than S minus K e raised to power minus RT. That is the limiting value of a European call option. For a put option, please remember the value can never be greater than the strike price. So put option is the right to sell. So let's say I'm selling you the right to sell at $100 and I'm charging you a premium of $110. Will you ever buy the put option? Because when will a put option come in the money? When the stock price falls. What is the minimum value that the stock price can get? Or even if your view goes right and the stock falls down to a value of 0, what is the maximum profit that you can have? $100. If it is a call option, or rather if it is a put option with a strike price of $100, then what is the maximum profit that you can have on the put option? Put option is the right to sell. So even if I sell it to him at $100 and I buy it at 0, that is the stock falls to a value of 0, what is my max profit going to be? $100. That is equal to the strike price. For a maximum profit equal to the strike price, will I ever pay more than the strike price? So even if I am 100% sure that the stock is becoming 0 or the company is going bankrupt, I will not pay more than the strike price for buying a put option. Again, value of an American put option will be greater than the value of a European put option because there's an added feature that you can exercise whenever you like. Similarly, from the put call parity, we can derive the minimum price. See, minimum price is 0 or this. If this is negative, then doesn't mean the price will be negative. Price is 0 or this value. So C minus P is S minus K e raised to power minus RT. Now we'll keep P on one side. So P will be C plus K e raised to power minus RT minus S. Price of a call option must always be greater than 0, or P must always be greater than K e raised to power minus RT minus S. So these are the limiting values or the maximum and minimum values of call and put options summarized again in this table. So call is always greater than or equal to S minus K e raised to power minus RT or 0. Put will always also be greater than X e raised to power minus RT minus S. The maximum value for a call option can be the current spot price. The maximum value for a put option can be the strike price. For a European put option, additionally, this maximum profit of X can come when? Only at expiration. So the maximum value will be X e raised to power minus RT, that is the present value of this X. And for a European put, this is what we just derived. Just remember, for an American put, the maximum value can be X minus S naught. Rather, the minimum value will be X minus S naught. That is how much it is in the money right now. So just try to memorize. Even if you don't memorize, just remember it can very easily be derived from the put call parity. Just rearrange and you will get the minimum value for a call, the minimum value for a put. Maximum values you need to remember, and we just proved why a call can never be more than the spot price and the put can never be more than the strike price. For European put, it will be X e raised to power minus RT. So compute the lowest possible price for a 3-month American and European 95 puts. The stock is currently trading at $90. For a put option, for a European put, it is K e raised to power minus RT minus S. For an American put, the minimum value is K minus S. K is given to be 95, risk-free rate is given to be 5%, and the time is 3/12 minus 90. So this will be the minimum price for an European put. And K minus S, that is 95 minus 90 or $5 will be the minimum price for an American put option. We derive this, we can derive it again. C minus P is equal to S minus K e raised to power minus RT, or P is equal to C plus K e raised to power minus RT minus S. C must always be positive, so P must always be greater than K e raised to power minus RT minus S. Only thing you have to remember is, for an American put, the minimum value is K minus S. That is the money that you can realize today by exercising the option. The strike price is 95, then today itself you can realize a price of, or a profit of 95 minus 90, that is $5. So 5 is the minimum price for a American put, and 95 e raised to power RT minus 90 is the minimum price for a European $95 put. Says that an American call option on a non-dividend paying stock should never be exercised early. So an American option is called American because it can be exercised at any time. Now theory says that American call option should never be exercised early on a non-dividend paying stock. If we exercise the American call option, what is the value that we will get? Or our payoff will be S minus K. That is the value that we get at exercise. So even if you need the money and you want to dispose of your option, theory says you shouldn't exercise it. That is, don't take S minus K. If you sell the call to somebody else in the market, the minimum price that you will get from an American call option is how much? The minimum price that you will get, or the minimum premium for an American or a European call option, will be how much? C minus P is equal to S minus K e raised to power minus RT. So C is equal to P plus S minus K e raised to power minus RT. So the minimum price that you will get, that is P has to be positive, so C has to be greater than S minus K e raised to power minus RT. So the minimum price, if you sell the call, C must be greater than this, will be S minus K e raised to power minus RT, which is always greater than S minus K. The risk rate is positive. If there is some time to maturity, this will be S minus K divided by e raised to power RT. So a lower number is getting subtracted. So this will always be greater than S minus K. So you should never exercise the option. If you sell it to somebody else, you will always derive a price, or you will always derive a value higher than what you would by exercising. If the asset pays income, then you can't say, because then S gets replaced by S e raised to power minus R star T. So this doesn't become S minus K e raised to power RT anymore. This minimum value will become S e raised to power minus R star T minus K e raised to power minus RT. Then this, you can't confidently say that this will always be greater than S minus K. So for dividend paying stocks, early exercise may occur, and especially if the dividend payments are large, then you may want to exercise right now, as the stock may come down in the future when the dividend gets paid. We can't say any such thing for a put option. So for a put option, it may be exercised early, it may not be. You'll have to see. By exercise, you will get K minus S. If you sell the put option, you will get the premium P. So there's no precondition that this P will always be lesser or greater. So you'll have to see whether selling is getting you more money or whether exercising the option is getting you more money. Just remember, for a American call option, the American feature is worthless if it is a non-dividend paying stock. That is, you should never exercise it early. You can sell a European call option also. European call option has a limitation that it cannot be exercised. doesn't mean you can't sell it. So you can sell a European call option. And even for American, we say that selling is better than exercise. Given strictly positive interest rates, the best way to close out a long American call position early would be to sell the call to somebody else. Which of the following statements about, never mind this one is, what is the lower pricing bound for a European call option with a strike price of 80 and 1 year until expiration? The price of the underlying is 90 and the 1 year interest rate is 5% per annum. So lower bound is S minus K e raised to power minus RT. That will be 90 minus 80 into e raised to power minus 0.05 into T. You can verify. This will come out to be $13.9. So that was about the review on basic options and option strategies. A very interesting and important concept. Make sure you practice many questions. Normally, if you get this concept right, you're pretty, or you don't have to repeat it, you don't have to revise it again. So make sure that you get your concepts clear the first time so that you don't have to spend much time on this topic again. And a heavily tested topic, a scoring topic, numerical topic. So it's a lot of black and white. So once you understand the methods, you can't get a question wrong. So make sure you maximize your opportunities on this section. Thanks a lot and see you next time.